So the
Now,
next tweet is S corp. It's another type of corporation. I actually have an S corp, which Stonehouse Ventures, which is my holding company for
yeah,
acquisitions. Yeah.
yeah, yeah. So the S corp, the point here, and there were a few comments on it on the thread on Twitter. Kind of applauding the point. I feel like this is rarely misunderstood. Um, an S corp isn't an entity type, and so people talk about, oh, you need to form an S corp. You actually don't do that. An S corp is just a tax designation. It's a filing you make with the IRS
That's
to
what
be
my
taxed
tax
under
attorney
subchapter S.
did, or my tax
Yeah,
account CPA. She did it. We're just filing a form with the IRS. Yeah.
that's right. So you don't form an S corp anywhere. You form a corporation, which by default is taxed under as a C corp, or you form an LLC, which is by default taxed as a partnership and pass through. But in either case, a corporation or an LLC, you can file with the IRS an S corp designation. So
Yeah.
you can actually have an LLC entity type, but elect to be taxed as an S corp instead of an LLC.
So the next one is the S corp is a pass-through entity like an LLC, but structured like a corporation. Um, so what's the big deal with the S corp, and why do some people like them?
So this now is where we get a little more into the nitty gritty. Okay, so when an LLC is by default a partnership, partners in a partnership can't be employees of the partnership, right? They take what are called guaranteed distributions or whatever you want to call them out of the LLC. What that means is that when you're a partner in an LLC, all of the profit that your LLC earns, your allocated percentage, if you own 50% of the LLC, 50% of that profit goes on your personal income tax return, and you pay income tax and payroll tax on the full amount. Okay. In an S corp, because it's structured like a corporation, but with the benefit of an LLC, the S corp is disregarded for tax purposes, which means it pays no corporate income tax. But because it's a corporation, the shareholders can now also be an employee of the S corp. So if you earned $1 million in your S corp last year and you're the sole owner, if it's an LLC, you're recognizing $1 million of profit and you're paying payroll tax and income tax on that full amount. If you're an S corp, you can make yourself an employee, pay yourself a salary of $100,000, and you pay income tax and payroll tax on that $100,000, and the other $900,000 you take out as a distribution, but it's a distribution that only gets taxed as income, not with a payroll tax.
Yeah.
So if you're talking $1 million and the payroll tax is several percentage points, this adds up pretty quickly, right? And so as companies start to grow out of their nascent stage of very small startup where they're looking into mid high six figures, certainly over into seven figures of profit, it starts to become a benefit from a tax perspective to be an S corp so that you can draw a reasonable salary and take all the rest as a distribution and avoid that payroll tax.
Yeah.
So that's how the S corporations became really popular.
Yeah. All right. So having a pass-through entity is important. S corps offer a unique advantage. Owner, right? We just talked about
This
that.
is exactly what we talked about.
Yeah.
That's right.
Having a $1 million property, you got really specific here. It's that 37% top federal income tax rate, 2.9 Medicare tax, 12.4. So yeah.
So a lot of people get tripped up on payroll tax because they're used to what they see in their W-2. If they're a W-2 employee, it's important to remember that payroll tax is paid 50% by the employee and 50% by the employer, right? So if you're a W-2 employee and you look at your pay stub, you see 1.45% Medicare and 6.2% on your SSI, your Social Security, and you may think, well, oh, that's not that bad. Well, when you're an S corp, you're now the employer and the employee, so you pay both halves. So it's a lot more than people sometimes appreciate if they're used to the W-2 world. It's doubled. Now, the other nuance to point out here, and I wanted to avoid a million comments that says, hey, you ignored that there's a cap on Social Security. there is a cap on Social Security. It goes up incrementally every year. So that 12.4% SSI is only owed up to $147,000. So everything north of that for an LLC, for example, you wouldn't pay that 12.4%, but you still pay the 2.9%. 3% of $900,000 in extra profit. That's a sizable amount of money. So it could pay to be an
absolutely. Yeah. If you're an S Corp, the shareholder can be an employee and pay himself a reasonable salary. And this is what you just talked about. So
exactly right.
The rest is distributed as dividends, meaning no payroll taxes on 1 million profit, assuming a reasonable salary is a fraction of that. So what's a reasonable salary?
Yeah, that's a tough question. And the IRS, of course, as they do in all things, give you no guidance, right? So you have to be a little bit, you're shooting a little bit in the dark, and what you're really worried about is an audit, right? So there's nobody when you file.
Oh, with 87,000 new agents.
Well, yeah. Let's not go down that rabbit hole, John. We'll be here all afternoon. Yeah. So in an audit, if they go back and look at this, they can challenge like, hey, you're a lawyer, you did $1 million in revenue last year, and you paid yourself $30,000. Come on, really? Right now, they're going to say this is starting to look like you are disguising your income, because the idea is that if you're the business owner, if you're an employee, you should be compensated like you were an employee, and the rest is your compensation that you're going to pay. Take the distributions, your capital gains as an owner of the business.
Yeah.
And so generally what you would do is you would look at what would someone in a similar position in the market get paid for doing this, right?
Are they more concerned about hiding income versus maybe overpaying yourself?
That's right. There's no penalty for overpaying, right? If you pay yourself a $200,000 salary,
you're gonna pay taxes on it. Yeah.
You pay some extra tax, and yeah, certainly the IRS loves for you to be conservative, right? It's where you get aggressive that they're going to take issue. So, like I said, if they can go out on Glassdoor and see that small 5-person law firm lawyers generally make $150,000 a year, and you paid yourself $30,000. You're playing games. You are understating. We're gonna hit you for those back taxes and penalties. But if you're within that range, right, that Glassdoor says between 120 and 150, and you pay yourself $120,000, it'll be tough for an IRS auditor to say, hey, you were understating your income. So there's no science there. You just have to be a little careful and be reasonable.
Thanks for watching this video. Make sure you're a subscriber by clicking on this button right here down below. And if you want to watch more serial acquirer interviews, click on this button right here. If you're ready to buy your first business, get my course at dealflowsystem.net right here. Take care. Cheers, John.